Dear students, good morning. Today we are going to discuss the concept of dividend decision. Dear friends, first of all, we would like to discuss the meaning of dividend. Dividend refers to the part of net profit of a company which is distributed among shareholders as a return on their investment in the company. Dividend is paid on preference as well as equity shares of the company. On preference shares, dividend is paid at a predetermined fixed rate, but decision of dividend on equity shares is taken for each year separately. A company should adopt a consistent approach to the dividend decisions on equity shares rather than taking decisions each year on a purely ad hoc basis. A settled approach for the payment of dividend is known as dividend policy. Therefore, dividend policy means the broad approach according to which every year it is determined how much of the net profits are to be distributed as dividend and how much are to be retained in the business. Thus, the dividend policy divides the net profits or earnings after taxes into two parts. One is earnings to be distributed as dividend and another is earnings retained in the business. Since dividends are distributed out of the net profits, there exists an inverse relationship between dividends distributed and retained earnings in the business. If larger net profits are distributed as dividends, retained earnings would be less, and on the contrary, if lesser profits are distributed as dividends, the retained earnings would be larger. The retained earnings are the most easily accessible, significant source of finance for the firm. A firm which declares large dividend will have to use external source of financing to finance its investment opportunities. Thus, a firm will have to choose between the portion of profits distributed as dividends and the portion plowed back into the business. The choice is called the dividend policy, and it will have its effect on both the long-term financing and the wealth of shareholders. As a result, there can be two possible approaches of dividend decisions. First one is long-term financing approach of dividend decision, and another one is wealth maximization approach of dividend decision. Now friends, we are considering the kinds of dividends. Dear friends, dividend can be paid in many forms. Main forms of dividend are as: one is cash dividend. Cash dividend is the most prevalent form of dividend. Most companies pay dividend in cash. Payment of dividend in cash depends on availability of cash balance with the company. The another form is stock dividend or bonus shares. Sometimes company issue shares to its existing shareholders free of cost rather than paying cash dividend. These free shares are called bonus shares. They are termed as stock dividend in the United States of America. Bonus shares are issued to existing shareholders in a fixed proportion over their existing shareholders. The another kind is scrip dividend. Sometimes a company has temporary shortage of cash. In such a case, the company may issue scrip scripts or promissory notes to shareholders, promising them to pay dividend at a certain date in near future. Such form of dividend is not prevalent in India. And another kind of dividend is bond dividend. The only difference between scrip and bond dividend is that the latter carries longer maturity date than the former. Thus, while issue of scrip dividend increases the current liabilities of the company, the issue of bond dividend increases long-term liabilities. Such form of dividend is also not prevalent in India. The another is property dividend. Under this form, company pays dividend in the form of assets other than cash. The company may give its own products in lieu of cash dividend. For example, a watch manufacturing company may give watches to its shareholders as property dividend. This form of dividend is not prevalent in India. And another form of dividend is composite dividend. In this form or kind, dividend in more than one forms are explained before is known as composite dividend. Dear friends, these are main kinds of dividends. Now, types of dividend policy. There are many types of dividend policy, like stable dividend policy. Under this policy, a company can frame a policy of paying a fixed dividend regularly. Under such policy, shareholders are assured of fixed dividend per share. Stable dividend may be declared at the present level, at a lower level, or at a higher level. The another types of dividend policy is low regular dividend plus extra dividend policy. Under this policy, a low rate of dividend is fixed, which is paid regularly, but in the years of extraordinary earnings, it also pays extra dividend. This policy is produced by those companies whose income considerably fluctuates from year to year. Another types of dividend policy is dividends fluctuating with earning policy. Under this policy, the dividends are changed according to the fluctuations in the earning of the company, and hence the dividend fluctuates from year to year. Shareholders get higher dividend if the company has higher earnings and vice versa. The another form is policy of no dividend at present. Such a policy is produced due to two reasons: when the company is not in position to pay dividend due to lower profit, and when the firm needs steady amount of funds to finance its expansion programs, and hence it decides to retain all of its profits. So friends, next or other issues we will discuss in next lecture. If you want to ask any question or any query from your side, then you can ask me through WhatsApp channel. Thank you.